In this session, which is named as Introduction to Accounting, first session, we will talk about what is accounting. We will discuss in detail the definition and process of accounting. So let's start by looking at some of the prominent definitions for accounting given by some institutions. In year 1941, the American Institute of Certified Public Accountants has defined accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the results thereof. This is the first definition of accounting. The second definition that we are going to looking at is in year 1966, the American Accounting Association defined accounting as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of information. The third definition was given in year 1970 by the Accounting Principles Board of American Institute of Certified Public Accountants. And this institution defined accounting as the function of accounting is to provide quantitative information, primarily financial in nature, about economic entities that is intended to be useful in making economic decisions. So these are the three very prominent definitions of accounting that we normally refer to. And on the basis of these three definitions, we can summarize the process of accounting as a process which has five basic steps, that is identification, recording, classification, summarizing, and analysis. So these can be the five different steps involved in the process of accounting. Now, let's try and understand the definition of accounting in detail. So, basis the three definitions what we have examined previously, we can define accounting as accounting is a systematic process of identifying and measuring, recording, classifying, summarizing, and communicating the outcomes of various transactions and events which are at least in part of financial in nature taking place during the life cycle of a business in monetary terms. So here I would like you to pay attention. This definition what we have written, you can see we have used two different inks. One is black and one is red. So the words which are written in red is the essence of this definition. And to make this definition more clear, what we are going to do is in the subsequent slides, we will discuss in detail each of the word of this definition, which is written in red ink. So let's begin. The first thing is systematic process. So when we say it is a systematic process, it means a systematic process is a way of doing something that follows a planned step-by-step method and involves all the parts of the system working together. That means To achieve an objective, there are 4, 5, 6 different steps or activities that needs to be carried out. That's number one. Number two, the steps needs to be carried out in the predefined systematic order. You cannot alter the order of activities or steps. For easy understanding, let's take an example of a student getting ready for school in the morning. So once you wake up in the morning, there are certain things that you need to do. For example, you will go to washroom, you will get freshen up, you will take a bath, then you will dress up, you will have your breakfast, you will pick up your bag, and you are all set to go to the school. Can you alter the steps like first you pick up your bag or first you dress up, then take a bath? No. So in order to achieve the objective, what is your objective? Is to get ready for school. And to achieve that objective of getting ready for school, you have to do these 4, 5, 6 activities in a predefined or in a sequential manner. So this is what the systematic process is all about. Next is identifying and measuring. When we say identifying means finding out which business activities or events should be recorded in the books of accounts. And measuring means giving those activities a value in money or monetary terms. So they can be recorded properly. So we can say identifying is choosing what to record and measuring is finding out how much it is worth in money. When we say recording, recording means writing down all business transactions in books of accounts in a proper and systematic manner. So we need to write the transactions. And what is transaction? That is something we will discuss in a little bit of time in this session. So when you are recording or writing down the business transactions, there is a proper way or a systematic way that you should be follow. This step of recording is either using journals, that means you are writing it down manually, or these days the accounting is done on computers using different accounting softwares. And when we are recording the transactions, we follow the double entry system of recording the transactions. Recording is like keeping a written record or diary of all the money related activities of a business. So nothing is forgotten. And this is the first step after identifying and measuring the transactions. Next, we step in the process of accounting is classifying, which means grouping similar transactions together under the right account heading so that they are easy to understand and analyze. Here, what we are doing is, as we will discuss further, so there are different types of transactions that we are doing in a business. Some of the transactions are leading to inflow of money in the business, whereas some of the transactions are leading to outflow of money from the business. So when we are doing the step of classifying, what we are doing is we are recording all the transactions which are leading to outflow of money from the business at one place, and all those transactions which are leading to outflow of money from the business at one place. And this is done in book, which is normally called as a ledger. And in ledger, each account, like We have an account for cash, we have an account for sales, we have an account for rent, we have an account of salary, etc., etc. Has its own place. So you can say that ledger is a, a book to keep the records, which has different pages, and on each of the page we record, we give it a name. So say for example, page number 1 is for cash. So any transaction which involves cash will be written on page number 1. Page number 2 is for sales account. So any transaction related to sales will be recorded on page number 2, so on and so forth. You can say classifying is like putting all the similar things in the same folder so that we can see how much was spent or earned in each category. It helps us to know the total rent paid. So as I told you that in ledger, there is one page for one account. So we have created an account for rent. And whenever we are paying rent, we are making an entry on that particular page. So if we want to find out that total how much rent we have paid, we don't need to go anywhere. We will just go to the page in the ledger where we are maintaining the record for rent, and we will do a total. And just by doing the total of one page, we can easily identify or understand that how much rent has been paid. Similarly, what is the total income or how much total salary has been paid or any other uh, uh, detail can be identified for some other account. Then summarizing. Summarizing means preparing final reports that show the total result of the transactions recorded during an accounting period. And later on, we will come up with a session where we will be discussing the different terms that we use in accountancy. And in that, we will discuss in detail what is an accounting period. For now, just consider accounting period as a time frame of 1 year. So summarizing is the process of preparing the final results, which will let the users know that how the business has performed during the period of 1 year. And when we are summarizing, different reports are created, and these reports are termed as financial statements, which includes profit and loss account and balance sheet. And these financial statements help to understand, help the users or the stakeholders to understand what is the overall financial position of the business. Summarizing, we can say, is like making a report card of the business. It tells how much was earned, how much was spent, and what is the final result. It helps the owners and others to understand how the business is doing. After summarizing, the next thing that we do is communicating. Communicating means sharing the summarized accounting information, like what is the profit the business has earned, or what is the loss the business has suffered, what is the total value of assets owned by the business, and what are the total liabilities which the business have on a given date, with the people who need it. Everybody, whosoever has any interest in the business, whether it is the owner of the business, whether the financial institutions providing loans and financial assistance to the business, or the creditors who are giving goods or services to the business on credit, the government authorities who needs to know the information on for tax calculation, or the researchers or academicians, or the government for making policies. So whosoever is interested to know how the business is doing, this information is shared with them. Or you can say communicating is like explaining the report card of the business, and this is done using the financial report so that others can also understand the financial health of the business and can take decisions accordingly. Outcome. So if we refer back to our definition, the word outcome was also written in red ink. So what is the meaning of outcome? Outcome in accounting terms means the final result that comes out after recording and summarizing all the business activities. Means what is the net result? Business has the business worked or for a period of 1 year, did hundreds and thousands of transactions, was involved in buying and selling of goods, doing different types of activities. And after doing all these activities, after putting so much of efforts, so much of time, after investing so much of money, what is the net result? Whether it is running in profit, if it is running in profit, how much profit has been earned, whether it is running in loss, if yes, how much loss has been suffered, so on and so forth. It shows whether the business has made a profit or loss, how much it owns and how much it owes. That means how much money which the business needs to recover from the market. Because as we all know, none of the business runs on 100% cash basis. At times, the business has to sell goods or render the services on credit to its customers. So, for the services it has already rendered or the goods which it already has delivered to its customers, it will recover money from them in future. So that is what it means, how much it owns. And how much it owes means how much money the business has to pay. Because if the business uh, A is selling goods or services on credit, similarly, business A is also buying goods and services on credit. So how much money the business needs to pay to others. So the outcome basically provides a clear picture of the financial position of the business. Next thing that we are going to discuss is transaction and event. Because when we say transactions and events, these are often uh, uh, used interchangeably, which is not correct. A transaction in a business, a transaction is a business activity or an event that involves exchange of money or money's worth between two parties and which can be measured in monetary terms. It is something that affects the financial position of a business and therefore it needs to be recorded in the books of accounts. That means any such event or activity that is happening at the business, place of business, or anything that is taking place in relation to the business, which can be measured in terms of money or it is affecting the financial position of the business, then only it is considered as a transaction and it needs to be recorded in the books of accounts. Like goods bought worth rupees 1000, the salary being paid to staff, selling of product for cash, or receiving money from a customer. So all these are events as well as transactions. Why these are events? Because something is happening, and when anything is happening, it can be termed as an event. But this is also a transaction. Why? Because of two reasons. Number one, it is impacting the financial position of the business. Secondly, it can be expressed in terms of money, or it can be expressed in monetary terms, or it can be expressed in financial terms. So remember, all the transactions are events, but all the events are not transactions. Why so? That is because an event is anything that is happening in the business and may or may not have a financial impact. It may or may not involve money. And if it does not involve money, then it will not be recorded in the books of accounts. And some of the examples of events are like the manager resigns. So the resignation submitted by the manager is an event, yes, but can be quantified in terms of money? No, we cannot. Or if we look at the other another example, goods sold for rupees 5,000. Yes, it is an event as well as it is a transaction. Why? Because selling of goods can be quantified in terms of money, that is rupees 5,000. So an event is something that happens, but it's not always recorded in accounts unless it involves money. Going forward, financial nature. Let's understand. Financial nature means anything that is related to money or money's worth. If something in business involves money, changes money, or can be given a money value, it is said to be of financial nature. So any such thing which cannot be expressed in terms of money, it will not, we will not consider it to be financial in nature. Monetary terms and fin financial in nature are very correlated, or they almost go hand in hand. So monetary terms basically means anything that is expressed in form of money. So if something is financial in nature, then we can very well express it in monetary terms. So the any monetary terms means anything that can be expressed in form of money, and the unit of measurement can be any currency. Okay, either it can be rupees, it can be dollar, or any other currency. To sum up, we can say if you can put a price tag on something, it can be recorded in monetary terms. I hope you understand these terms well, and the definition of accounting and process of accounting is also clear to you. Here we are putting up a very simple graphical representation of process of accounting. The first step is accounting. The first step of process of accounting is identifying and measuring. Second one is recording. Third one is classifying. Fourth one is summarizing. And fifth one is communicating. So this is with this, we come to the end of first session. We will come up with the second session very soon. Thank you.